Hi, everybody. Welcome to Tricio's webinar, New World Order, 115 Days of Trump. Today, we're going to be joined by John Calverley, Chief Economist, and myself, Gerry Celaya, Chief Strategist. And we're going to be talking about what lies ahead for the major markets after 115 days of Trump. John, over to you.
Okay, thanks, Jerry, and thanks everybody for joining. Seems like more than 115 days, but there you go. So what the agenda today is, we're going to look at where we think US policy will likely settle. There's been a lot of ideas thrown out, a lot of policies delivered, but exactly where they will end up, that's important. Looking at what it means for the US and the world, and then we'll look at the implications for markets and opportunities outside the US, and Jerry will contribute on that part. So first of all, some very, very punchy policies, no question about that. Listing some of them here. Deterring asylum immigration. It looks as though the numbers of people coming in is going down from about 1.5 million a year that we saw in 2022, 23, 24, down to probably zero this year and possibly even negative next year. So big change there. There's the attempts to cut government spending, Elon Musk, Doge, all that. There's a new verb now called to be doged, which means to be lose your job. Tax cuts. We'll talk about the bill going through Congress at the moment. Talk about tariffs, obviously. All of this is a very aggressive, confrontational approach, confronting the bureaucracy, confronting the courts, and of course, allies. This has led to concerns around the process involved here, fears for the rule of law, and also fears about crony capitalism. And I'll talk more about these as we go along. So on the immigration side, this chart is from the CBO. You see where it says projected, that actually starts in 2021 because they're not entirely sure of the numbers after that. But nevertheless, that peak you see, 22, 23, 24, population grew about 1% in each of those years, largely because of this immigration. That played a big role in helping to keep employment growth strong during those years, while also helping to bring wage growth down. So it was a big benefit for the Fed, in a sense, helped to bring inflation down, but it's changing. It was already coming down in the last year of Biden, and with Trump, it's coming down very rapidly. You can also see the dark green bars at the bottom is the birth minus deaths. You see the dip obviously during COVID, but notice that's going down and will turn negative in the next decade. The US population growth is slowing quite a bit, and that does mean that over time, we're likely to see a slower trend growth rate in the US, and beginning really as early as this year. Now, what about Doge? There's lots of numbers flying around, quite difficult to get firm on them. Looks like it might be 100 to 150 billion annually in savings. That's quite small beer in relation to the whole budget, which is around 7 trillion, and in relation to the budget deficit, which is around 2 trillion. Although it's actually quite a big part of the discretionary non-defense budget. If you look down, fifth line down on the right, non-defense discretionary, about 800 billion, that's the figure. So if they take out 100 to 150 billion, that's pretty drastic. That's quite substantial. But it won't change the overall arithmetic for the budget very much. There may be some cuts also in one mandatory category, which is the Medicaid budget. You'll read about that. But that's probably going to just push the spending back onto the states rather than eliminate it. So it's not going to make all that much difference. Tax cuts. To me, it still looks as though the budget deficit is going to stay high. Obviously, a lot of the discussion on tax cuts is rolling over the 2017 ones, which were due to expire at the end of this year, but also adding tax cuts on Social Security, on tips, on overtime, even on car leases, provided they're an American-built car, one of Trump's favorite ideas. Trump has talked about increasing the tax on incomes over $2.5 million, although that's not currently in the bill. But there's also a big discussion about raising the state and local tax cap against federal taxes, which is actually worth a lot of money. If they do raise that significantly, it will cost quite a lot. Obviously, on the revenue side, tariffs will bring in some money. The numbers floating around at the moment are in the area of 100 to 200 billion. So again, significant but not massive. So the net of this is I think the budget deficit's likely to stay near 6% of GDP. You can see the figure here, very high for a non-recession and non-war period. It's something that I think is going to be in increasing focus as we go through the summer. The last couple of months has been really almost all about tariffs, at least on the external side and on the market side. I think increasingly the budget deficit is going to be an issue. So we'll have to see what they come up with. We'll know for sure probably in early July as it works through. Now, a high budget deficit like that means that the debt ratio will continue to rise. It's already at the highest level since World War II. These projections are from the CBO, and they're not real because actually these assume that those tax cuts due to expire at the end of this year do expire, which they're obviously not going to do. So the actual line beyond the projected, the upward sloping line there beyond the dotted projected line, is going to be steeper sloped than this, most likely. So there's a serious issue here, which is really not being addressed, and we'll have to see how that plays out. Let me turn to tariffs. I wrote a blog a few weeks ago arguing that there would be forces pulling the tariff rates back down and bringing a lot of exceptions. But nevertheless, Trump does want some tariffs, so they're not going to go away. He wants some revenues. He also wants to boost manufacturing jobs, but he doesn't want too much inflation or too much disruption. He does react when white-faced chief executives call him up and say, we can't deal with this. In fact, some people are already talking about taco. Trump always chickens out. I think there's beginning to be a bit more of a relaxed attitude in markets now that he won't push these things too far. But anyway, we'll have to see how that works. So we argued a few weeks ago, and I think this still broadly holds true, that the outcome of this may be a 10% tariff on most countries. That's what we see in the UK, for example. UK does not have a trade surplus with the US. Nevertheless, it faces a 10% tariff. Higher on China, perhaps 25%. Higher also on certain products, including cars, steel, aluminium, and pharmaceuticals. There will also likely be lots of exceptions for individual products and even companies. What it means is that the average US tariff rate will go up from around 2.5%, probably to something like 12 to 15%. You can't be exact on these things because it also depends on how imports react. As imports go down, because it's just too expensive, that brings the average tariff rate down because they're simply not imported. But something in that area. And that's back to what we last saw in the 1940s. Very, very high rate, complete reversal, new world order, if you like, compared with where we were. Now, what are the implications of tariffs? In the short term, it's pretty clear. Jay Powell has talked about this. It's stagflationary. It will slow GDP, probably something like 0.5%, maybe up to 1%. And it'll probably lift inflation temporarily, 1%, maybe a bit less. Those are the sorts of numbers to expect. So this is not a disaster. And I think as Trump has pulled back a little bit on his tariffs, and most economists have pulled back a bit on their fears for recession. Some people still say 50%. We probably put it a bit lower than that now. Definitely the risk is higher than it was. But the chances are that the US, which probably would have grown at 3% otherwise, will simply grow somewhat slower. The doubt is over the uncertainty effect. We've got a lot of anecdotes about firms holding back on hiring, holding back on investing. It's very hard to know, how that will play out and how long it'll last. It will show up in the data increasingly as we go through May, June, July, I think. That could hurt the economy more. Probably think it's not enough to cause a recession now, especially if Trump continues to backpedal a bit. What about the long-term impact? Well, Trump wants to recreate manufacturing in the US. And that means I think that a lot of multinationals are going to have to say, right, we need two supply chains. We need one for the US, where we rely primarily on the US and maybe on Mexico and Canada, although the picture for Mexico and Canada is uncertain at the moment. And then you'll have a second supply chain, the rest of the world. And the rest of the world one will be cheaper for the most part, simply because the costs in China, Vietnam are cheaper. So that will make the US less competitive. It'll hurt US exports, and it'll also obviously hurt consumers. So it's not a good outcome. but multinationals will have to go for both, I think. And then crony capitalism, I mentioned it. Trump does respond to lobbying, so big companies have an advantage here. I think we'll see more of that. We'll see more favors going to Trump, going to his party in return for help with tariffs. So that raises the broad question of, is US exceptionalism dead? I think the peak of discussion of US exceptionalism was probably January, February this year. We put out a piece back then in February, a little bit skeptical of it, but now people are saying, well, it's definitely dead. So some of the arguments here for why it's gone, the US had this enormously strong growth coming out of COVID. The economy is about 12% bigger than the fourth quarter of 2019, whereas Europe and the UK are 3 or 4% bigger. It's a big difference. But there's specific reasons for some of that. The US fiscal stimulus was much bigger. The Ukraine war hurt Europe much more than the US. Rising policy rates affected mortgage rates in Europe and the UK because people have short-term mortgage fixes. In the US, most people have 30-year mortgages, so it didn't affect their payments. You had a very strong US wealth effect as stock prices and house prices soared in the US. Most of the consumer spending we've seen has come from the top half of the population. We also had the shale oil boom. Trump talks about drill, baby, drill, but actually the output of oil and gas went up substantially under Biden, and the LNG exports began to take off. We also had more recently substantial investments in AI, in servers and chips for AI, and that's definitely helped keep growth stronger as well. And all this took the stock market up, and it took the dollar up, and it made investments in US assets much more rewarding than elsewhere. But there's reasons for thinking that the US is not finished at all. And they're more long-term reasons. Many of them are reasons that have been around for a long time. The entrepreneurialism in the US, the skilled immigration, to some extent linked. We know that a lot of the successful entrepreneurs are actually immigrants, but that's because the US is a very attractive place to open a business. You get less regulation, you've got a large competitive economy. You've got a strong tech sector in the US, and that's one of the fastest growing sectors in the economy. It also has these increasing returns to scale, which means that you can build huge stock market value from that. And also create moats against new competitors. And the US obviously has a lot of outstanding companies, particularly in the tech sector, but elsewhere as well. Turning back to some economic numbers, the US exceptionalism, you could see that in investment. Dipped slightly during COVID, but it's basically powered on up. You look at the UK, was holding up until the Brexit referendum. And since then, investment in the UK has underperformed. It's been doing a bit better recently, which is very encouraging. I think that's probably the 100% depreciation now allowed. Compared with Europe, where investment collapsed during the debt crisis in 2012, 2013, and it's recovered some, but you can see it's barely higher than it was in 2007. So investment in Europe is still very, very weak. I mentioned the wealth effect in the US. House prices everywhere rose in 2020, 21, but then they went sideways, essentially, in the Eurozone and the UK. In contrast, they carried on up in the US. House prices basically are 50% higher than they were pre-COVID. It's a huge benefit for Americans. And they've been spending that. It also means, by the way, that to the extent that interest rates come down, you will see people tapping into that equity, which will help to keep growth going. And then on the supply side, productivity has slowed down everywhere. The blue bar here is 1999 to 2013. The orange is 2014 to 2023. So you see the US was highest and is still highest, but down quite a bit. It's basically close to halved pretty much everywhere. Not very good in the UK, particularly bad in France and Italy. So US is still the best though, even though it's slower than before. Just briefly on inflation. We've done a lot of webinars over the last 3 years or so, and inflation's always been a key topic. I'm just going to show one slide on it this time. And the story essentially is that it is still too high, particularly in the UK, but it looks like it's set to fall. And we think that certainly in the Eurozone, it'll reach the 2% level soon. US is going to take a bit longer because you're going to have this temporary pickup. And the UK is going to take a bit longer because it starts from higher. But we do think that it's going the right way and that inflation will come down as hoped, as planned, as targeted. So what's happening in the rest of the world in terms of the cycle, in terms of economic growth and so on? I mentioned inflation's coming down in the Eurozone and the UK. In Japan, it's coming up to 2%, and it seems to be established there just about now, which is good news. They are gradually raising rates, which wouldn't normally be considered good news, but it's kind of a normalization of the Japanese economy. They're moving slowly at the moment while they wait to see how the tariff thing works out. Meanwhile, economic growth is picking up this year in all three regions. We just saw the UK GDP number for Q1, quite good. China still has a lot of problems, and we're skeptical on the medium term. I'm not going to say much more about it this time because there's not really time, but it is on a cyclical basis, it is working through the property bust. The property starts are down about 60%, so there may not be much further to go on that. And we are seeing more fiscal and monetary stimulus out of China now, as well as, of course, out of Europe, which has been one of the big stories this year, moving to spend more on defense, more on infrastructure, and so on. Worth mentioning that in terms of tariffs, the effect of this is worse for the US economy than the rest of the world. With the possible exception of China, I should also mention, I suppose, Canada and Mexico, depending on how they work out. But the reason why tariffs are worse for the US is that they affect 100% of US imports, and they may also affect a large portion of their exports if there's retaliatory tariffs. Whereas for Europe, exports to the US, 10-15% of total exports. So the effect is less. The other thing to watch out for is to the extent that Trump actually forces countries to reduce their tariffs, that's good news for those countries. We always have to remember that tariffs are bad for you, the country that puts them on. So when you look at the UK-US agreement, such as it is, yes, it is good news, of course, for Jaguar and Land Rover that they can export more cars, but it's also good news for UK consumers that Trump has opened up a few areas for more US exports. But in terms of the rest of the world economy, how it works from here, it's going to be confidence that's important. And we do need the tariff thing to settle down for that. I would also point to consumer confidence generally. This chart shows the savings rate as percent of income. If you look at the blue line, the UK, obviously all of them went up during COVID. People couldn't spend, couldn't go out, couldn't get hold of goods. But look at it post-COVID, UK savings have jumped up about 5 percentage points of income. And that's what's been holding back the economy a lot. People are very, very cautious. Cautious because they're worried about taxes, worried about higher mortgage payments coming, just worried about the economy generally. And you see some of that in the Eurozone as well. And that's definitely held back the economies in those countries. Now, the good news is that usually the savings rate, for example, in the UK, doesn't stay at this level for very long. It starts to come down once things pick up a little bit, and that can reinforce growth from here. And the same with the Eurozone. You can see that outside COVID, the savings rate's higher than it's been for the last 20 odd years. Turning to some valuations quickly, and then I'll pass over to Gerry. I talked about US exceptionalism and the longer term factors that play into why the US is exceptional, entrepreneurialism, large market, highly competitive, and so on. Arguably, that is reflected already in the price earnings ratios. You can see that the green line here is the forward ratio for the US, around 21 times. It departed from the pack about closer to 12, 13 years ago. Obviously dipped recently, but it's come back a lot of the way. The rest of the pack, and this includes emerging markets, UK, Japan, Europe, all around 12 to 14 times. Much more modest, fairly modest relative to their own history, and certainly much cheaper than the US. So effectively, the US is at a 50% premium already. So to the extent even that you like the US, and there's good reasons to continue to like the US despite Trump's efforts, it's already to some extent reflected in prices. So that's definitely worth bearing in mind. And then briefly on bond spreads, We did see quite a lift, particularly in the higher risk stuff a few couple of weeks ago. Some of that's closed again. So if you compare with previous sell-offs, it's not been a particularly big sell-off, and the level currently of these yields is not particularly high. I think that's sort of saying that people are not expecting a recession. Fair enough. In terms of absolute yield, of course, that single B, well over 7.5%, that may be attractive. But if you get a recession, those yields will definitely widen out substantially. So there's still significant risk here. So just to conclude, what Trump's policies mean, I think slower US growth in the short term because of the tariff hit on consumers. In the long term, largely because of the slowdown in population growth, but also because of the loss of competitiveness due to tariffs. Greater inflation risk, I think, in the short term, and probably also in the long term. In the short term, obviously, because of the tariffs. The long term, because the effect of tariffs and making the US less competitive, closing some markets, or at least putting a wall around some markets effectively, that does allow firms to be less competitive, to allow firms to raise wages. So I think that's a concern. There's also a slight concern that over time the Fed will become less independent. I wouldn't make too much of that because I think it's institutionally quite strong, but we will be watching who is appointed to replace Jay Powell next May. So that's a bit of a concern. Less predictable US policy. That's definitely been the case the last 3 months. A lot of people think that's not going to change very much. Maybe we'll get more used to it. Maybe it'll become a bit more predictable. Things could change, obviously, with the midterms. The Republicans are likely to lose the House. They're probably not the Senate, but losing the House would make it more difficult for Trump to push his policies through. But Trump keeps coming up with these policies, and the courts push back. We'll start to see more court judgments soon, and that can also change things around suddenly. So that's an issue. So what investors are talking about now is they're saying, well, there's a new risk premium on US assets because of all this, because of the greater inflation risk, slower growth, less predictable policy. There's even some people concerned that there are elements in the US government under Trump that even want to potentially put on some kind of capital controls, things like that. I don't think that's very serious, but it has been raised. It's enough to make people a little bit cautious. So if you have a new risk premium on US assets, that implies potentially lower stock valuations than before and a lower US dollar, which is what we've seen. It may also imply higher long-term bond yields. And again, we do seem to be seeing that. It's very difficult to separate out that from expectations of growth. But nevertheless, it does seem to be the case. And just to emphasize, US stocks and the US dollar are still in expensive territory. But international investors are looking to diversify, no question. That's what all our clients are saying. But the US still attracts, and that's something that you have to balance out. Okay, so I'm going to pass over to Gerry now.
Thank you, John. That was a great background for everything that we're looking at the moment. The first chart we're going to look at is a US 10-year note yield. And the reason for this is because so much is captured by what's going on in this market. Now, our overall view is that it's likely to hold below 5%, and we could see attempts to work lower towards 3.6% and even lower. 3.6 is where we were last summer before the Fed started cutting rates. And the coupon curve, which is the spread in the yield between the 10-year and the 2-year notes, we expect that to continue to steepen. Remember, it was down at negative 100 basis points a year and a half ago, and since then it's up to around 50 basis points now in positive area. We think it'll go to 80 basis points and maybe a little higher. Now, these are theoretically reasons to rejoice, but it's one of those things where it depends on why bond yields are going lower. If bond yields are going lower because inflation concerns go away, then maybe that's great. If bond yields go lower because the economy is in trouble, maybe it's not so great for stocks. So it's one of those things that we think bonds have a really good role to play in a portfolio, but you have to be holding it for the right reasons. Now, at our last asset allocation meeting, we actually reduced our overweight positioning to neutral. And the reason for this is we needed to free up some room for some equity ideas, which we'll show you later. But right now, bond yields are expected to be capped, and we expect them to work lower over the course of this cycle. Now, here's a semi-log chart of the S&P 500, which we use as a benchmark for the US equity market, like many people do. And you can see that we're stuck in a broad ascending channel, which we have been for some time, since the 2008, 2009 lows. And it continues to remain the case that we are in a bull market, in our view. Now, bull markets can have deep, deep wobbles. And the beginning of this year, when we talked with clients and webinars, we said, and in the end of last year as well, we were saying the same thing. We're stuck in a bull channel. Whenever we get to the top of the channel, we get a little bit worried because you can have pullbacks from there. Naturally, that's just the way channels work. And we did indeed have a pretty significant pullback. Now, what do we expect from now on? I don't think we're going to see a huge amount of upside for the rest of this year. We might see new highs. I think we'll struggle to hold them, and we might wind up closer to a flat year than negative 20% down or positive 20% up. It could be one of those years where we go back and forth and we end up near unchanged. Here's the NASDAQ 100, which captures a lot more of the high tech part of the US equity market. Again, it's a semi-log chart to give you the percentage moves. And again, we're stuck in a large, broadly ascending channel. Now, here we had a little bit more of a pullback than we did in the S&P because some of the high tech shares had a lot more room to give up. But again, it's a nice bounce so far. And what we can see here is that there's room on the upside. So we're not giving up on tech yet. And we still think, as John pointed out, there's reasons to think that some firms can continue to do well. Tariff uncertainty is obviously a whole big negative for the market. But once tariff uncertainty becomes tariff clarity, which we hope will be the case over the next few months, then you could see tech shares maybe not outperform as much as they have in the past, but at least hold up rather than fall out to the bottom of the channel. Now, one of the themes that we've been working on for the last quarter or so is the fact that the US exceptionalism has come under fire. Now, our chief economist, John Calverley, he's written some blogs about this and some focus reports, and we've written about this in our monthlies, where basically we expect some of the idea that European shares will always lag US shares to be questioned. And we've seen that this year so far, and it's worked out pretty well. So we're overweight European, the broader European market, which we summarize as the stock 600 because that includes the UK. And we expect new highs to be seen here. Now, we did have a significant pullback in April, but as it becomes clear that, as John pointed out, US tariffs will probably impact the US more than other countries like, or country or blocks like the Eurozone, the UK, and other trading partners, then we should see markets migrate to the countries where they're not hit that hard. And we've seen that through all the anecdotal data, all the flow data, where more and more fund managers are looking at European ideas, including the UK to some extent. So we think that'll continue, and we expect new highs here. Now, the SOX 50 is a narrow part of the market. That's basically the Eurozone top 50 shares. And you can see here it's done very well. We had a huge setback in April on the back of the Trump tariffs. But there's so much uncertainty still about what exactly the Europeans are going to do with response to the tariffs. It's one of those things where as long as the US imposes tariffs on all their imports, the US economy is hit the hardest. If the Eurozone starts doing something similar, then I think European growth might be questioned a little bit further. However, if Europe does what other countries are doing, which is basically say, you do what you want, we're going to stick to targeted tariffs or at least some sort of response that's not, out of the question, then I think the Stoxx 50 does have room on the upside. So we're looking for new highs here as well. Now, the FTSE 100, again, it's a very old school index in terms of the makeup. You got lots of pharma, you've got the miners, we've also got the oil and gas sector, and you've got banks. So it's one of those things where it can be seen as a bit of a value play, but it's also definitely a high dividend, and that could be some of the sin stocks in it as well. However, for our purposes, we still like the FTSE 100, and we think it's probably going to make new highs as well. We had a big pullback in April, but again, you've seen the big bounce back as well. And we don't see anything in this chart to suggest that we're not going to actually test the top of the channel over the course of the cycle. So when it comes to stock markets, we still like the UK. Now, here's the UK 10-year gilt. That's one of those things that this is one of the few bond markets that actually pressed above the 2023 yield highs recently, and we had a bit of a wobble. The gilt market does get shaken out now and then, but so far we still think we're going to hold below 5%, and we're aiming for 4%, maybe a little lower. Now, it's one of those things where if UK yields do work lower for the right reasons, inflation coming down, as John said, then that should be okay for the stock market. Obviously, the caveat here is if yields collapse, it's going to be for a reason like the economy doing badly or so. But overall, we expect gilt yields to work lower over time. Now, one of the things that we do for clients is we always try to look at different markets for ideas and investment flows, especially markets that we know that they're interested in and we're interested in. One is Japan, where we had a great time catching the post-COVID bounce, and we think there's still a lot of room on the upside here. Now, it's one of those things where the Bank of Japan is raising rates. The yen has firmed from levels that we saw earlier this year, but it's one of those things where do we actually think the yen is going to firm a lot more? Is the Bank of Japan going to raise rates aggressively? The answer to both of those is probably not. We're looking for the yen to firm gradually, and we're looking for the Bank of Japan to continue a gradual rate rise, which should be taken well by the stock market. Obviously, everybody's watching the Trump tariffs to see what hit Japan is going to wind up with. But it's one of those things when we look at this chart, we see support holding up. We haven't really broken down below the that flat blue line and the rising blue lines. We're getting some sort of support building up here, which is great. And we think that the next move is going to test the upside of the channel and maybe extend it higher. So it's one of those things where we're looking for the topics as one of the countries that could benefit over the next course of the cycle. Now, we also look at China, and we made the point over the last, ever since we started Tricio, that China is part of the emerging market indices is probably pretty hefty, and people should be aware of the exposure they have. Now, last year, we decided to go back to neutral from being underweight for the best part of 4.5 years on China. We said, look, it's time to go neutral. They're starting to do stuff in terms of offering more considered stimulus to the economy. And as John pointed out, some of the problems are being worked through over time, namely the property sector bust. Now, how exuberantly positive are we? Not that exuberantly positive. However, we do think that as a recovery play, China does have room on the upside for equity market gains, and we think that'll be encouraging. So we're looking for maybe not new highs in the cycle, but at least climbing away from the base. And there should be an easy 10, 15, 20% on the upside over the course of the cycle for Chinese shares. And the final emerging market chart that I'll show is Latin America. Now, we talked about this because in Trump 1, we saw Latin American currencies get shaken out to begin with, then firm. And we've seen the same thing this time around as well. So that gives the index a bit of a kick because it's a dollar-based index, or the ETF. So it's one of those things where if Mexican peso remains flat to firmer, that helps returns because like I said, it's in dollars. At the moment, still think it's an early recovery stage here. We're starting to break above the moving averages, and we'd be looking for a return to the highs that we saw the last year and a half. And there is potential to actually do better than that. But that's going to take a lot of what ifs from the world economy. In other words, there's no huge recession. And a lot of these, remember Brazil and Mexico are the biggest components of the index and the ETF. So you're going to need to see some sort of positive global growth stories coming through to actually power these shares higher. Now, John, that was my brief voyage through the equity markets and bond markets. I think the last slide, next slide, please. That's us, James Chu, our colleague, myself, and John Calverley. And for anybody who wants to read our research and contact us, we can be reached at the emails here on the screen, info@tricio-advisors.com. Thank you for everybody, and thank you for joining us, John, James. Thank you, guys.
Thanks, Gerry.